I don't think I have put up the recording from our last session, but I will get that up. The recordings, as you know, are there to supplement our live discussion or synchronous discussion in case you want to go back and look at something. So I will be continuing to post those up on Canvas. I think I have a couple up there at this point, which you can see there. Let me put this in, probably best if I put it in student mode. So it looks like how you're seeing it, student view. Okay, good. And so you can see that I have posted a couple recordings up there, and I think we have one other one that from last time, and of course I'll put this one up as well. For today's class, I definitely am committed to finishing the chapter 1 slides, and embedded in the chapter 1 slides are the practice midterm questions for chapter 1. So we'll go through those as well. Remember, the practice midterms are designed to start that process of understanding how you're going to be tested on this material and start to build your confidence in your ability to answer questions in the format of the exams. And it will be multiple choice questions like of the nature that you will see as we go through and look at those. Now, for chapter 1, I went ahead and just embedded them in the slides. For other chapters, as I do for chapter 1, I didn't embed them in the slides, but I did provide this Word file that has the questions. So we'll see them embedded in the slides, but I just also want to point out that you do have a Word file with the same questions. Now, obviously, I've highlighted the answers, and since I won't be doing that on the exam, what you may want to do is remove the highlighting here, and that's fairly straightforward. When it's in Word, you simply click the little highlighting pen, choose no color, highlight the entire document, and that will remove the coloring. And many students find that that is a good way of preparing for the exam, because you have to, of course, respond without having seen the correct answer highlighted. So I just wanted to point out that that file is there for chapter 1, as it will be for the chapters as we go forward. And in fact, we won't be having them embedded in the slides anymore. That only occurs for chapter 1. Any question on that? Okay, good. Then if there are no questions, I'm going to go ahead and put my machine in tablet mode. Hopefully my camera won't wig out on me. Okay. And then I'm going to, I don't know what that is, go ahead and put my slideshow in slideshow mode, and let's go ahead and start it. Okay. Now, just reviewing what we've talked about so far. We talked about the Security Exchange Commission. It has the authority to set the accounting standards. They have pretty much delegated that to the Financial Accounting Standards Board. The Financial Accounting Standards Board then promulgates generally accepted accounting principles. Those generally accepted accounting principles are then used by companies to prepare their financial statements. The financial statements that we are considering in this class primarily are the balance sheet, the income statement, and a portion of the statement of stockholders' equity called the statement of retained earnings. And we will get to the statement of cash flows, which is something that is covered in another class. So I say we'll get to it as you go through your different classes, 1B, 1C, and whatnot. You'll see that. Now, when we look at the balance sheet, we saw that it was called the balance sheet because it balanced. And what balanced? Assets equal liabilities plus stockholders' equity, right? Was the equation. We did the example here where we saw that you have your assets, say cash, You have cash in one pocket, that's an asset because it has future economic benefit. But in the other pocket, you have a bill, you have a liability. And I'm saying it like that so that we understand the liabilities are our bills. And say you have a $40 cell phone bill in your other pocket. Well, then your owner's equity, your stockholders' equity, if you will, in that $100 is really only what? Only $60 that are left over. So when we look at the balance sheet, we can see what's the financial position of this entity. Yeah, you've got these assets with future economic benefit, but you've got these bills that are claiming some of the right because they're going to have to peel off and pay, say, $40 to a cell phone bill. And so you're really only left with 60. That's your financial position. Okay. Now we went through, go past these, and we had this sort of silly little example where we did the lemon tree thing and we ran around, and as we had various transactions, we kind of slapped them down on the balance sheet, on the income statement, and then we kind of spun off and prepared a little statement of retained earnings. And we saw that the balance sheet balanced when we took our earnings off of the income statement and stuck them into the piggy bank, the retained earnings. And we did it for a couple of different years and saw that the equation stayed in balance. Primarily, the big step to balance it was that we took our net income off of our income statement, stuck it into our statement of retained earnings. The ending balance of retained earnings went up, and as a result, the balance sheet balanced. And then sometimes a company may pay themselves a dividend, and so they'll pull some money out of the corporate accounts. So our asset cash will come down. And because we are paying out a dividend, we are not retaining our earning, we're paying it out. We're no longer retaining it, we're dividing it out amongst our shareholders, called a dividend. That reduced our retained earnings, and the equation stayed in balance that way. Any question on any of that we've sort of been covering so far?
I have a question.
Mm-hmm.
For the last slide, sorry, the one with the example, the other one.
This one?
I think it's the next, the last one.
This one?
Yeah. So, when you did the calculation for like the cash sale and the fertilizer, and then it ended with $8,
Mm-hmm.
and then the arrow points to cash. I assumed that it was gonna be like the difference because it was the end of $8 and the revenue was $15, but you added it. Can you clarify why you did that for me?
Well, when we look at these financial statements, okay, what these financial statements are doing are showing the results of transactions that have happened, right? So by the time you're preparing your balance sheet, and notice I say here at the end of year one, okay, what we're reflecting is, well, what is our financial position at the end of the year? What do we have in assets? What do we have in liabilities? What do we have in stockholders' equity, right? So by the end of year one, remember, we started out with what? With the $20 of lemons. I'm just going to do the same thing with lemons that I did with the cash. Okay, so we had $20 of lemons, but we sold what? We sold 5 lemons. So we sold what? We sold $5 worth of lemons. And so we were left with what? Because the lemons were $1 each, we ended up with $15 of lemons. And so when I prepare the balance sheet, I want to show, well, what do I got? I've got what? I've got lemons that are valued at $15. And then I brought in $15 of cash from those sales that we made of the lemons. We sold 3 lemons at we sold 5 lemons at $3 each. That's that $15. So that brought in cash. But then I reached into my wallet and I paid the fertilizer store $7, right? So I was left with what? I was left with $8 cash. So I looked and said, okay, I got $8 of cash. So I went to my balance sheet and wrote cash $8.
Oh, I see. Okay, so the 15 is different. Okay, I
Yeah.
see.
So I had the $15 of cash, but I spent 7 on fertilizer, so I ended up with $8. So I mean, literally in this simple little crude example here, I went in my wallet, $8, okay, and I wrote cash $8.
Mm, okay.
Okay.
Mhm.
And then I went to the lemons and I said, okay, 15 lemons, $1 each, lemons, $15. Um, there was something else I wanted to say there, and it flashed in and then flashed out of my mind here. Oh, and then I went ahead and of course I wanted to tell my total assets. I'm not sure if that was part of your question. My total assets equal 23, right? The $15 worth of lemons, the $8 of cash gives me $23 of total assets. And that balance to there are no liabilities in the year one part of this example. So it was the $20 of stock that I had issued plus the $3 of retained earnings. And my net income went into, and I'm just going to draw the little nose here for the piggy bank. Remember, my retained earnings is what? Beginning balance, which was 0 because I just started the business. I add what? Net
Net.
income, right? Good, the $3. Oops, the $3. I don't know why lately I've been having trouble writing a dollar sign. $3, and then subtract dividend. Dividend was what? 0. And so the ending balance was 3. That's basically the statement of retained earnings. I mean, that's what that statement of retained earnings does. And then you go ahead and just pull that up and report that as your ending balance and retained earnings on the balance sheet, because the balance sheet has to balance what balances? Assets, the lemons and the cash, plus liabilities plus equals assets equals liabilities plus stockholders equity. We don't have any liabilities, so we're left with our stockholders equity, which at this point in your understanding of accounting is stock and retained earnings. So I add those two, the 20 plus the 3. I kind of wrote over it now, and that gives me the 23, the balance sheet balances.
Okay, that makes sense.
Okay.
Thank you.
Any other question? Okay, good. So let's just go ahead then and let's look at a little more sophisticated version of the financial statements than me scribbling all over the whiteboard there. And we have what? We have revenues. First, we start with the income statement. Let's look at it that way. And we call it the income statement because we report what? We report net income. How do you calculate net income? Revenue minus expenses. Revenue minus expenses. So our revenue was 4,700 in this example. We have these various expenses. We subtract them. We're left with a positive net income of 2,750. The second statement then that we prepare is our statement of retained earnings. And our statement of retained earnings in this example had a beginning balance because they just started the business, had a beginning balance of 0 because they just started the business. We add in our net income from the income statement. You can see, just like I kind of pointed crudely on my little example, comes down from the income statement into the statement of retained earnings. Then sometimes a company, they don't have to, will pull out the dividend. Okay, so this is what? This is the piggy bank, isn't it? The statement of retained earnings really is, the formal name for what we're sort of, I don't know, playfully, for lack of a better term, calling the statement of retained earnings. We're calling it the piggy bank. And then we pull the stopper out of the piggy bank. And sometimes we pull out a dividend. A company doesn't have to. If I'm an investor in a, for sort of, starting company, I'm probably not interested in a dividend. I'm like, look, I just gave you some money. I just bought your stock. And I'm buying your stock because I believe in this starting business, and I want you to use that capital to generate revenue. Don't be sending me back a dividend at this point in time. I might almost be annoyed by a dividend. If I'm dealing with a more mature company, then I'm saying, okay, yeah, you've had some time to build up some retained earnings. I expect that you should be paying me a dividend. And there's no right or wrong answer on that. It depends on the perspective of the investor. Somebody your age, maybe you're looking for what they call a growth stock. You want them to hold the money that you just paid in terms of buying the stock and whatnot to grow the company. Whereas someone, my age, I'm going to look at, I'm getting to a point where I'm going to need to be, sitting in my backyard, looking at the view, wondering what happened to my life, whatever. Stop, John. Okay. But I'm sitting there and I'm not going to be interested necessarily in a growth stock because I don't have time to wait for the growth. So I might buy a dividend stock and then expect dividends. So it really depends on the position of the company, the perspective of their investors. But sometimes a company will go ahead, pull out a dividend. If I'm paying a dividend, if I'm dividing my earnings out, that means I'm not retaining them. And so it comes out of the piggy bank, out of retained earnings, and then we have that ending balance in retained earnings. And then that ending balance in retained earnings really is what comes in to then allow the income statement to affect the balance sheet, because now what? Now my income comes in to the piggy bank and it helps to balance the equation. Assets equal liabilities plus stockholders' equity. And as we've said, statement of cash flows will come up in a different class, which is right here. So the third thing we prepare is the balance sheet. Question. Okay, good. Now, as we were finishing up last time, I did ask you to take a look at this set of slides and go through and see if you can look at a description of a transaction, which is what they're going to be giving us here, and see how that affects various accounts, and then for the balance sheet, for the income statement, and then also see how that ultimately will keep the equation in balance, assets equal liabilities plus stockholders' equity. So guys, be prepared. I'm going to be asking you to call out to me, and so you're probably going to want to unmute here pretty quick. I'm going to be asking you to call out to me what happens to what account based on the description of the transaction. Now, if you're looking at this description of the transaction at this point, and there's something you don't understand, you need to ask me. I mean, I'm going to be describing what's going on here, but by the same token, you may be confused or not see something that to me is so obvious because I've been looking at accounting for almost 40 years now. I've been looking at accounting for probably about 40 years now. I mean, I think I was about 20 when I took my first accounting class. So I've been looking at this stuff for a long time. And there are things that I don't see as something that somebody would not understand. You've been looking at accounting, potentially for a month now, and you're going to see this much differently than I am. Okay, so if there's something you don't understand, guys, don't be shy. Don't think that, I better not ask that. Just ask it so that we deal with this at this time. Remember, this is the training, the boot camp part of this class. This is where we're building up the callus, the scar tissue, whatever you want to call it, that is going to allow you to build upon your understanding as we go forward. So let's deal with any things that are, confusing to you, any, areas that are gray to you at this point. Let's just deal with them now rather than, carry those weaknesses forward as we're trying to build up our strength. Okay, so let's go ahead and take a look at this example. And it tells us here that this Ray and Barbara Neal decide to open a computer programming service. It says he names it SoftBite. I mean, they're together. Why didn't they decide together what the name is? So anyway, Ray and Barbara decide, let's edit this a little bit. that the name of the company is SoftBite. So on September 1st, that's when they start the business, and we'll say it's 2022, whatever the year, doesn't matter. They invest $15,000 cash in exchange for stock. Okay, here we go, guys. I'm turning it over to you. If I bring in cash, is my cash account going to go up?
Yes.
Good. So the cash will go up 15,000. And if the corporation is issuing stock in exchange for this cash, what other account should go up?
Common stock.
Beautiful. Common stock should go up. And of course, the equation will stay in balance because we've increased an asset. We increase the stockholders' equity. The thing balances, right? Good. Excellent. That's exactly how I want you to do this exercise with me. Beautiful. Good job. Okay. Question.
Yeah, if they're investing 15,000 in cash, doesn't that mean I guess I saw it as a subtraction of their actual cash because they're paying 15,000 for 15,000 in common stock?
Well, Ray and Barbara Neal are human beings. Okay, let's just look at it that way, right? They are a separate legal entity from the corporation.
Okay.
So
So
they're
make a
taking
color
money.
like make an orange color or something like that. So I know that you made a change of it.
Okay, guys.
I don't have to go look through the history. I just know, this is what
Hang
all
on a
the
minute.
white account. That's why I color code this blue.
Elizabeth Hassler, who's talking?
Okay. Pay that surface or in this range.
I was asking the question.
Okay, I'm
Sharon.
sorry. Okay, hang on. Let me mute all and then unmute yourself because okay, it looks like they stopped. Okay, I think we're okay. Okay, guys, if you're gonna be talking to, now I have to get out of this. Okay. If you're gonna be talking to, your dog or whatever, please, mute yourself. Okay. Now, Elizabeth, sorry, I didn't mean to indicate that you were doing something wrong, which you weren't. I must have heard another voice there. Okay. Past that distraction. So they are people, right? The corporation is a separate legal entity. So they're reaching out of their personal bank account and they're putting money into the corporate accounts. Let's say they had a manager that was running the business, right, for them. Well, the manager would have the authority to spend their money as the manager of the company sees fit. Okay, so when you take an asset like cash and you put it into a corporation, you're giving up the legal right to that cash. But of course, you want something to show that you have control of this separate legal entity. So what you do is you take back stock. The corporation, the separate legal entity, issues you stock. And with that stock, you would have the right to control that company. We're assuming this is they're the only shareholders in this example, and they have the right to control that company. So from the corporation standpoint, they're sitting there saying, well, we got some cash, but don't forget, we do have owners out there, okay, that actually control this entity. We call them shareholders, and we represent that by showing that we've issued them common stock.
Okay. Thank you.
Anyone else? Okay, good. Now we come over and we take a look at this next transaction. Got our first transaction done. And now SoftBite, notice it's not Ray and Barbara anymore. It's now the corporation, goes and purchases computer equipment for $7,000 cash. So, could be a manager over there deciding, hey, I'm going to need a computer up in here. So I have the authority as the manager here. They've given me authority to purchase equipment, right? So if I purchase equipment with cash, is my cash going to go down?
Yes.
Yeah, my cash will go down. What will go up?
Equipment.
Good.
7,000.
Excellent. The equipment goes up 7,000 and the equation stays in balance because everything happened on the asset side of the equal sign. Question. Okay, good. Then I go and I purchase for $1,600 from Acme Supply Company, computer paper and supplies expected to last several months. And they tell me that I purchased that on credit, okay? When an accounting question description says that I have purchased something on credit, that means I'm going to have a bill. That means I'm going to have to pay that later, right? Okay, and so if I have a bill, okay, of $1,600, let's start with the liability side. Is my liability going to go up?
Yes.
Yeah.
Right. I'm going to have an account pay a bill, and I'm saying it funny on purpose. Correct way to say it would be account payable. I'm going to have an account pay a bill. I have a liability that I'm going to have to pay. So that's going to go up on the liability side. What else is going to happen?
Supplies go up 1,600.
Right. My supplies will go up, and we know that it's the supplies an asset because it said it will last several months. Therefore, it has future economic benefit. And so good. The asset side goes up, the liability side goes up. Good. Stop me if there's a question, guys. Okay. Okay, good. We look at number 4. Services have been provided for cash. Okay, so we provide a service. And when you provide a service, you generate revenue, right? When you provide a service, you generate revenue. And so our revenue, okay, which is reported here under stockholders' equity, which is shown here. I shouldn't say it's reported because we wouldn't show it that way on our financial statements. We wouldn't issue financial statements showing revenue as part of stockholders' equity. But for this exercise, we have shown it here under retained earnings. So my revenue is going to go up. And what else is going to go up?
Account receivable.
Cash.
Yeah, it says we received cash. So if we receive cash, the cash account goes up, right? I thought I heard somebody saying accounts receivable, huh?
Yeah.
Okay, so the cash goes up, the revenue goes up, right? And we put that under retained earnings, or I don't know that I would have necessarily shown it this way, but I decided it's okay to go with this. If we were to prepare an income statement right now, why do they call it the income statement? Why do they call it the income statement? Huh?
Because of the net income.
Because it reports net income. Good. And how do you calculate net income?
Revenues minus expenses.
Good. Revenue minus expenses is how you get net income. Okay. Do we have any revenue?
Yes,
Yeah.
the 1,200.
Good. Do we have any expenses so far?
No,
No expenses so far. So our net income right now is 1,200, isn't it? Okay.
Yeah.
Now, where do we put our net income? In the piggy bank. Statement of retained earnings. Beginning balance is what? 0. They just started the business. Net income
the 1,200.
is 1,200. There's no dividend at this point. So the ending balance is 1,200. Okay. So what this thing is trying to show you is what? Well, look, my cash went up on the asset side, and ultimately my retained earnings is going to come up on the liabilities plus stockholders' equity side of the equal sign, because my revenue went up. When my revenue went up, my net income comes up. When my net income comes up, ultimately my retained earnings comes up. That's what they're trying to show you here. Okay. Question. Okay, good. Let's go ahead then and let's take a look at the next transaction. Okay. And we purchase advertising on credit and receive a bill for $250 from the Daily News for advertising, but we postpone payment until a later date. Okay, so what happens? It's on credit. We haven't paid it yet. It's a $250 bill. And before I kind of unfurl the answer, whatever word you want to use here, do you think my liabilities are going to go up?
Yes.
Yeah, my liabilities are going to go up, right? Now, you look at this advertising and you think to yourself, well, maybe advertising has future economic benefit, right? But are you sure that it does? Are you sure that because you do advertising, people are going to come into your store?
No.
No, I mean, half the advertising I hear on the radio annoys me so much. I'm thinking I would never buy that just because I hate your stupid commercial. Okay, so maybe you're decreased business if you have a poor advertising campaign, right? Or lousy commercials, whatever. And so FASB tells us that if you don't know that an amount that you are committing to spend here, if you don't know that that amount has future economic benefit, treat it as though it has expired. Treat it as an expense. Okay, so what's going to happen? We've agreed our liabilities are going to do what? Our liabilities are going to go up and our expenses are going to go up. Now, I know they showed it as a subtract because ultimately what? Ultimately, an expense is a subtract from my retained earnings, but I don't report it on the statement of retained earnings. I report it on the income statement. So again, let's make up our income statement. At this point, we have revenue, and we have revenue of what? Just look at the accounts, guys. Revenue is 12. My expenses, what? Were 0. Now they've gone up to what?
250.
250. Revenue minus expenses gives me what? Net income. Help me out here, guys. You know I'm not good with math. 1,200 minus 250 is what?
950.
950.
950. Good. And then on my statement of retained earnings, okay, and again, since we had just started the business, the beginning balance was 0. We have what? We have to add the net income. The net income is 950, comes up from the income statement. Still no dividend, so our subtract for dividend. For dividend is 0. And so the ending balance is what? 950?
950.
Okay. And that then would be added to my retained. That what 950 was added to my retained earnings. That gives me the ending balance of retained earnings. So the reason they show it as an minus here, really the expenses went up. When my expenses go up, my net income comes down. When my net income comes down, my retained earnings comes down, right? And the equation stayed in balance because on the same side of the equal sign, we had an up, we had a down in equal proportion, equal amount. Question. Okay, good. You come over and you look at this next one, and now the company provides some service, and we're going to get some cash, but we're also going to offer some credit here. So we do $3,500 worth of programming services. We receive $1,500 up front, and the remaining $2,000 is going to be paid a little bit later. If someone's going to pay you later, do you have future economic benefit?
Yes.
Yeah. By the way, do you have a favorite asset? Have you selected a favorite asset yet?
Cash.
Cash is my favorite asset. Okay, so yeah, I like cash. My second favorite asset is what? Accounts receivable, because it's going to be cash pretty soon, isn't it?
Yes.
Okay. All right. Now, look, guys, you don't have to, sit here and choose favorite assets. I say I like cash the best, but then, some people would look at the way I spend money and say, you must hate cash because as soon as you get something, you're trying to spend it. Okay. But anyway, just have a little fun with it. Okay. But the point is what both are assets, right? So you may very well do this. You may very well have a good customer say, hey, you can pay me the remaining on that, give me 1,500 up front, and then you can pay me the rest later. Okay. Now I've provided the service though. The service has been provided. Okay. So notice something here. I go ahead and I take the revenue because I've provided the service. What causes me to report that I have earned a revenue and I'm going to put it on my income statement is not the receipt of cash necessarily. It is what? It is the providing of the service. I only got 1,500 of the cash, so the cash goes up, and the remaining 2,000 now does what? The remaining 2,000 goes into my accounts receivable to increase that, and the equation stays in balance because my assets came up 3,500, my revenue came up 3,500. When my revenue comes up 3,500, my net income goes up 3,500. When my net income goes up 3,500, my retained earnings will ultimately go up 3,500, and the equation will stay in balance. So, two important things to really start to get clear in our mind from the last two transactions, transaction 5 and 6 here. Notice we took an expense, even though we hadn't paid that bill yet, and we took a revenue, even though we haven't fully received the cash. So what causes us to recognize a revenue is the providing of the service. The thing that causes us to recognize an expense is the expiration of the future economic benefit of that money that we have committed to pay, not the what? Not the actual outflow of the cash. Very important thing to start to really get comfortable with in this class. Question.
So you treat the service being provided as an actual money amount to balance it out.
Well, I know what I billed the person. I know what I charged the person for that service, right?
Right.
So, and I went and I did whatever. Say I cleaned their backyard. I said, okay, that's going to cost you 3,500 bucks. And the person looks in the backyard and says, well, that's beautiful. That's the nicest looking. I'm saying backyard, guys. I'm looking at my backyard. That's the nicest looking backyard I've ever seen. That's beautiful. Okay. So what happens? The work is done. I've earned that revenue. Okay. So I can say, hey, I earned $3,500 worth of revenue today. And I put that in my revenue account here, right? And then they hand me 1,500. So my cash account has obviously gone up, and they owe me 2,000, which, if they don't pay me, I'm going to go to court, and Judge Judy's going to say, and when I start the job, I take a picture of this messy backyard. When I'm done, I take a picture of this beautiful, clean backyard. And if they refuse to, and I have a contract that says they'll pay me 3,500 to clean their garage, their backyard. So I go into court and I show the contract. I show the before and after pictures. The judge looks at it and says, you're going to pay this person $2,000. So there is a future economic benefit there, that 2,000, right? So I take the 3,500 revenue. I take the 1,500 that I have of cash, and I put that I'm going to get cash at 2,000. One way or another, I'm going to get that cash. Does that answer your question?
Yes.
Well, there was a slight uptick in your S, which.
Yeah, so I'm sorry, I'm still trying to absorb it. So it's
What are you trying
because
to
it has
absorb?
future economical benefit is the key to it being considered a revenue.
Well, no, I mean, not really. What causes me to recognize the revenue is I provided the service. I provided the service. That's why it's a revenue.
Okay.
I provided the service. That's why it's a revenue. This idea that, hey, it's going to provide future economic benefit, that's why it's a revenue. No, it's I provided the service. What if I owed you $3,500 and I said, well, look, I ain't got it. I'm a little tapped out. Can I work it off? And you say, okay, you know what? Yeah, go ahead, clean my backyard. And I'm a business, right? I have this liability of $3,500 that I owe you. And you ask me, hey, you know, instead of paying me cash, I'd really like you to clean my backyard and I'll cancel that liability, right? So what happens? I do my work. And in this case, I'll increase my revenue, but I'll decrease my liability because I don't owe you that money anymore because we had a contract that in payment of that liability, I would clean your backyard. Now the equation stays in balance because my revenue went up, my revenue goes up, my income goes up, my retained earnings goes up. And on the same side, so my stockholders' equity came up. On the same side of the equal sign, the liability came down 3,500. So the key to recognizing revenue is the providing of the service, not, although the common case is that your future economic benefit goes up, even in the form of cash or receivable. But there are many, many business transactions where maybe a liability goes down as a result of providing the service, the earning of the revenue.
Okay, that I understand that better. Thank you.
Yeah. So again, that's fine. So again, what causes me to recognize a revenue is the providing of the service.
Providing of the service.
Okay. What causes me to recognize an expense is the expiration. And guys, I'm not trying to be condescending by saying it that way. I just want you to see the connection between, you know, what these words are sort of telling us. The expiration is what causes future economic benefit is what causes me to recognize an expense. If I pay an expense in cash, then, you know, whatever, and I dump the fertilizer on the ground, then there is no future economic benefit associated with that item I bought, right? Yeah, that's it. Okay. Okay, good.
I have a separate question.
Yeah.
So technically, this may be a dumb question, but like for the 250 for the advertising expense, does that technically make the equation unbalanced since both of them are on the other side of the equal sign?
No, because on the liability side of the equal sign, right, it went up. My liabilities went up because now I have this bill. You know, we're on a different transaction now, but remember they gave us a bill, right? They're billing us for this advertising.
Yeah.
So my liabilities went up. You got that. And then on the same side of the equation, if a transaction is contained on the same side of the equal sign and a liability goes up, then I know a stockholder equity is going to have to come down, right?
Okay, now I see it because it technically zeroes out. So it's 0-0 both sides.
Correct. But again, Mal, I want you to really, you know, follow that thread, right? Which is the reason it stayed in balance is because what? Because my expenses went up. When my expenses go up, my net income comes down. When my net income comes down, my retained earnings comes down, right? So
Yeah.
it ultimately reduced the retained earnings, but the expenses increased, didn't they? From 0 to 250.
Yes. Yes. Okay. I understood that part. I was just
Okay.
like curious about the equation itself, but then I just
Okay.
realized.
Yeah. Okay. Okay, good. Okay, good. Let's go ahead.
I'm so sorry, Professor. I do have a question. I'm
Yeah,
actually a little confused with the jargon with the common stock. So normally when the small business form, they invest something here they invest 15,000 to establish the business. Do they have to go SABI or we can just entry on the as book as a book common stock?
I got everything but the very end. What did you say at the very end there?
Does they have to go through the SABI for issuing common stock or this is just for
Okay,
the data entry?
do they have to go through the what?
SABI, the Security Exchange Board for the common stock, or they do the just data entry for the book?
Um, okay, the SEC, you mean Security Exchange?
Yeah,
Okay,
yeah.
okay. What an entity would be doing, a small company like this, is they would be going through the Secretary of the State. Okay, it's generally the office where you form a corporation under state charter. In California, it's the Secretary of State, where you form that corporation. But then you start to have different investors, and there's different rounds of funding that come into companies. So there's sort of an angel round where you're going out to your friends and family and saying, I'm trying to get this business started. Do you want to join in? And you probably going to issue them, and frankly, you're probably going to issue them non-voting stock. You probably issue them something called preferred stock as opposed to common stock. And then you start getting into different rounds, and it really depends on the amount of funding. And for our guest speaker, after I post up the video for that later on in the term here, he'll talk to you about dollar amounts associated with Series A securities, Series B securities, but you're still not officially issuing you're issuing shares to external investors, but they're more seen as, not the general public. Finally, when you get to certain dollar amounts, that's where you tend to go in terms of fundraising. That's when you start to go public, to do an initial public offering. And at that point, the SEC will make you file a form. I think it's called S1 form. And with that S1, and there's a lot of back and forth as they ask you for different things. And then ultimately they approve you to have an initial public offering. And with an IPO, what happens is really underwriters, investment bankers, basically come in and take down a big chunk of your stock, give you the money, and then they start trading your stock amongst the public that way. So I don't know if that's what you were asking there for sure, and that might be more than you were asking.
Yeah, I just wanted to know what will be the book entry, the data entry. It should be common stock, preferred stock as a. If we don't go through the
Depending on the
SEC.
class of stock, but I don't want to teach accounting 1C tonight. Okay, but yeah.
Okay, thank you.
Yeah. But yeah, or wherever that's taught, 1B, whatever. There are different classes of stock. And so, yeah, if I was issuing one of those non-voting shares, then it would probably be preferred stock and not common. Okay, good. Any other questions? Okay, good work, guys. Let's keep going here. And let's look at number 7 now. And they tell me that I pay some expenses and I pay them in cash. Okay, so if I pay something in cash, is my cash going to go down?
Yes.
Yes.
Okay. Caught you napping. Okay, so my cash is going to go down by the total amount here. And then they chose to show each one of these expenses separately, but basically my expenses are going up. When my expenses go up, my net income comes down. When my net income comes down, my retained earnings comes down. When my retained earnings comes down, my stockholders' equity comes down, right? So in this case, they just paid their expenses in cash. Then what? Then I go ahead and I pay that bill that I had. If you pay your bills, do your cash come down?
Yes,
And you don't owe that bill anymore. So you pay a bill, your cash comes down, your liability account payable comes down. The equation stays in balance. Okay. Okay, good. Then what? Then we receive $600 from the customer that we had billed for services. Okay, good. We offered credit to these people and they paid us. Okay, so when someone pays you cash, when you receive cash, does your cash go up or down? Up. And since they paid me some amount, the what? The amount of the receivable goes down. And then they decide to pay a dividend out. So we're going to take money out of the corporate accounts to pay that dividend. When I pay money out of my corporate accounts, does my cash go down?
yes,
Yes.
Good. What else comes down?
Your dividends?
common stock,
No. The piggy bank says I pay the dividend out of what?
corporation pays it.
Retain earning?
The piggy bank, we pulled the little stopper out, we pulled the dividend out of retained earnings, didn't we?
Yes.
Okay, so my corporate cash comes down. If my corporate cash comes down, my dividend goes up. If my dividend goes up from 0 now to 1,300, my retained earnings comes down, doesn't it?
Yes.
Yes.
Okay, there it is. Now, when you look at these ending balances in these accounts, let's look at this. We've got revenue 4,700 total. They just added it up. They've got total expenses. They just added these up of 1,950, don't they? Okay, so can we prepare a income statement? Can we prepare an income statement out of this?
Yes.
Revenue minus expenses is how you calculate net income. Note to self, I gotta get rid of that slide. It's kind of annoying. 4,700 of revenue. There's those expenses. My revenue is 4,700. My expenses are 1,950. Revenue minus expenses, I report on the income statement, equal net income, 2,750. See how easy preparing financial statements are? You keep track of the transactions as you go. And then once you see what the balances are on these various accounts, you just pull the amounts from these accounts in the form of financial statements. There they are. There's the income statement. Now I can prepare the what? Statement of retained earnings. The first statement I prepare is the income statement. Second is a statement of retained earnings. They just started the business, so the beginning balance in my statement of retained earnings in my piggy bank, the beginning balance was 0. I add net income. There it is, came down like they showed. And then I pull the stopper out of the back of the piggy bank, and what? I take out that 1,300, it's coming out. Okay, and so I subtract my dividend. And then I have the ending balance in my retained earnings, which is 1,450. Question. So notice, guys, before I paid that dividend, my dividend account was showing what? Was showing 0, wasn't it? After I paid the dividend, now the dividend account is showing, hey, you took 1,300 out of retained earnings. So when I prepare my statement of retained earnings, whatever the beginning balance was, 0 in this case, God, I gotta get this thing is annoying. Let me hide this slide. 1 second, guys. This is a little annoying. Okay, so I'm sitting there and now I'm reporting that dividend coming out of the retained earnings on my statement of retained earnings, and then I have the ending balance. Now, notice something, guys, that the expenses have the same effect. Let me say that the other way. The dividend has the same effect as the expenses do on retained earnings, but we report them in different places. Revenue expenses is something that gets generated in earning the revenue. So we subtract it from my expenses, from my revenue to calculate my net income. Once I have income, it goes into the piggy bank. And then when I pull it out of the piggy bank, this is not money that I am having to pay out in the generation of revenue. This is a pulling out of the earnings that gets reported on the statement of retained earnings. So even though expenses and dividends both ultimately decrease retained earnings, in one case it decreases, in the expense case it decreases retained earnings by the fact that it's reducing my net income. In the case of the dividend, it comes straight out of income that I have already deposited into the piggy bank. Question.
You just answered my question.
Okay, good. That's called 30 years of teaching, right? Okay. All right, good. So then, huh?
I did notice that in our slides provided in the modules on campus, we don't have that final line where it has the like 8,050 plus 1,400. Is that like on purpose?
Where is that? Which one?
So, because I simultaneously look at the slides in the modules, because sometimes if you change the slides, I look back to like record it on my notes. But that final line with the 8,050 plus 1,400 plus 1,600 is not in our slides. Was that like on purpose?
I think what might be happening there, Mala, is if you're not in slideshow mode, you won't see it. You have to be in slideshow mode.
Oh, okay, thank you.
Yeah. Okay. Okay, good. Yeah, there really shouldn't be any differences between what you're seeing and what I have, because I pretty much use what I gave you guys. So, if you do see something like that, that would be unusual. Okay. Okay, good. Now we go over, and the third statement we prepare is the balance sheet. Okay. And so it's literally looking at these accounts, Molly, where you're saying you weren't seeing the numbers, but you see it here in slideshow mode. You see, hey, cash 850, accounts receivable 14, supplies 16, equipment 7, right? My retained earnings, my accounts payable 16. My common stock is 15, and I know what my retained earnings is because I'm going to pull it down from the statement of retained earnings. And so sure enough, that's what they did. They just list the different accounts, cash 850, receivable 14, and so on. Add that up. That's my total assets. Liabilities 16, common stock 15, and pull the retained earnings down from the statement of retained earnings and the balance sheet balances. Statement of cash flows, another class. Question. Okay, good. I'll tell you what. Accounting careers. If you're thinking about an accounting career, guys, what you want to do is you want to think about taking the CPA exam, passing the CPA exam. These numbers that you see here are a little old and they are not indexed for the Bay Area. Okay. I'm here to tell you that if you told the chief financial officer of Apple that this was the amount of money they were going to make, they would weep openly. Okay. So, you know, if you're thinking about accounting, you can expect to come in at about, you know, 70,000 these days. Okay, you'd come in at about 70,000. And after a couple, 3 years, you know, you should be up over the 100,000 mark. And again, I'm here to tell you that as you start to move up this chain, you know, the money starts to become, you know, probably you could expect to earn about a couple 100,000 in a pretty, you know, high level position. And then as you start to really move up, you know, these numbers can get larger. And then if you are fortunate enough to land a position as a CFO with a big corporation, you know, you can expect to see in the millions of dollars of compensation. Question? Okay, good. Now you come over and you want to take a break, or you want to go straight to the practice midterm, and then we'll adjourn class after we complete this, or you want to take a quick break?
A break would be fine.
Yeah, I'm kind of feeling that too. So why don't we go ahead, take about you know, a little less than 10 minutes. Let's do we'll do 10 minutes. Let's do 10:46. Okay, we'll come back at 10:46 and we'll pick up this exam. Okay. All right, guys, I'll see you in a couple minutes. Okay, guys, let's go ahead and let's jump in to the practice midterm discussion here. And the midterm that you will be taking for midterm 1 and midterm 2, and then the final, again, is like a glorified midterm because it just covers the chapters from midterm that we cover after midterm 2 to the end of the class. Will be like this. There'll be multiple choice questions. Sometimes most of the time there'll be 4 choices. Sometimes there'll be 5. So you'll have A, B, C, D. Sometimes you'll have E. You'll take the exam in Canvas, and we will take it during the class session on the date, whatever date this is called out on the syllabus. Okay. So by becoming comfortable with these practice midterms, chapter by chapter, and then we have the more comprehensive practice midterm, for example, for our first midterm, there'll be a practice midterm that will, a more comprehensive practice midterm that will cover chapters 1, 2, and 3. So we'll do them by chapter like we're doing now for chapter 1. Then we'll have a comprehensive one, which will pull material from all 3 chapters for that first midterm, for example. We'll practice with that. The idea being by the time you have worked out with this stuff, you should be in pretty strong shape to be able to do well on the actual exam. Okay. All right. So let's just go ahead and let's start to take a look at this. First one, we say, which of the following, and guys, you know, I know I've highlighted the answers here, but sort of jump in with thoughts and whatnot as we go along. But which of the following is not an external user of accounting information? You remember when we prepare financial statements in our 1A, 1B, 1C discussion, we're preparing financial statements for external users, those outside the company. When you get to managerial accounting, then you'd be looking at the information from the standpoint of an internal user. So we say, which of these are not external? Well, regulatory agencies, the IRS, the Security Exchange Commission, they're external to the company, obviously. Customers are external to the company. And sometimes I'll get students say, well, why are customers external? Well, look, if you're going to Nordstrom and the phone starts ringing on the other side of the counter there, you don't go around the other side and say, Nordstrom, can I help you? Because you know you are not part of Nordstrom. You're external to Nordstrom. And remember, we said that customers may be interested because maybe they're signing some sort of service contract with a company and it's going to cover over a couple of 3 years. And you want to know that they're going to be around to be able to provide this service that, let's say, you're paying up front. So you might be interested in their financial position. Investors, okay, investors are obviously external and they're also considered what? A primary user. So even though, and you can see the answer in here, all of these are external users, right? We have primary users. Our primary users are investors and creditors. Regulatory entities, customers are external, but they're not our primary users. So when the FASB thinks about asking a company to provide information in their financial reports by issuing a standard, a general accepted accounting principle, they are basically thinking about primary users, the investors and the creditors. Okay. So when you look at this second question, which of the following is a primary user? Ding, A is obviously the correct answer because it's a creditor and investors are primary users. These others, SEC, IRS, they're external, but they're not what? They're not primary users. Question. Okay, question 3, and you know, I kind of contemplate maybe I should take it out of here, but then again, it might be interesting. I wouldn't ask you this on your exam, but remember, we talked about the Financial Accounting Standards Board and the International Accounting Standards Board, and there was a time when it was thought that the US would go over to international financial reporting standards. That never happened. US companies fought that. And so the US maintains its sovereign standards issued by the FASB, whereas many countries, usually emerging economies, tend to adopt IFRS as their accounting standards. So when it was clear that we weren't going to have the US come over to IFRS, the FASB and the International Accounting Standards Board got together and prepared a conceptual framework together. Conceptual framework is the rationale as to why FASB or the IASB should require companies to do something. And the idea being that if we're working from the same basic framework, then our standards should be pretty close to each other, although there will always be differences between what the FASB issues for US GAAP and what the IFRS, International Accounting Standards Board, issues in IFRS for countries that choose to use IFRS. But despite these differences, this process of working off the same conceptual framework is called convergence, trying to get the two standards to come together. So it's more of an evolutionary process than a revolutionary process, where it was thought at one time the US would just go over to IFRS. That never happened. Okay, good. Come over, liabilities of a company would not include, read questions carefully, guys. A lot of times, even for my CPA students, you know, that are getting ready to pass the CPA exam, they read too quickly and they miss that not, and then they choose A right away because they didn't read the question carefully, because the first one is a liability, but this question is asking what is not a liability. So notes pay up bills liability. And if you just went ahead and said, oh, I got that, and didn't read every choice, I don't care if you feel that God spoke to you and told you that A was correct, always read the other choices, because maybe you didn't read something very carefully in the question, because you read B and it says accounts pay a bill. Well, that's a liability too. What the heck's going on here? It asked me what is not a liability, right? Salaries and wages pay a bill are a liability. Cash is what? That's a question.
Asset.
Asset.
Good. Cash is an asset, possibly your favorite, right? Okay, good. Excellent. Number 5, the origins of accounting are generally attributed to the work of, and we didn't talk about this in class. This has more of a history lesson than anything, not something I would probably ask you on your exam. But back in the 12th century, Venice, which is part of Italy now, but at that time in the 12th century, Venice was seen as its own republic, and it was an economic hub. It's there in the middle of Europe, and there were a lot of things going on in Venice at that point in time. So this Catholic priest, Lucia Pacioli, wrote in his journals about a lot of different things that were going on. And one of the things he wrote is that business, mostly men in those days, business people were using something called double entry bookkeeping, which is something that we're going to really start to focus on in chapter 2 and use through the remainder of this class. Okay, something called double entry bookkeeping that Pacioli wrote about in his journals. And sometimes he's called the father of accounting. Sometimes people say he invented it. He didn't invent it. He just wrote about it in his journals, but he wrote about a lot of other things. So this system that we're going to be really starting to dig in, and maybe some of your colleagues in other classes are already struggling with this. I don't like to rush you to this. We're going to start to deal with it next time. But this double entry system has been around since the 12th century, what we're going to be talking about in class next time. If something's been around since the 12th century, what does it tell you about that system? They haven't changed
Pretty
something.
reliable.
Reliable.
It must be pretty useful, right? I mean, sometimes, no, it doesn't necessarily mean that. Oh, yeah, well, the Roman numbers were around at one point in time. And the only reason you know Roman numbers now is because of the Super Bowl. Okay, once they discovered, hey, this Arabic number system is much better, much easier to use, they threw away Roman numbers pretty much, right? Okay, for any kind of purposeful use other than talking about the Super Bowl. Okay, so what happens? And I suspect even the Super Bowl people now are probably going and saying, wow, this is going to start to get pretty tough for people to figure out which Super Bowl we're talking about as these go along. So they may switch. They'll probably switch at 100, I would guess. But anyway, enough of that. It tells you that it must work. What else does it tell you? It's easy. It's got to be easy. Chemistry, for some reason, I've gotten this weird interest in chemistry lately, and I think I'm going to get myself an introductory to chemistry book. Chemistry can be as hard as it wants to be, because as hard as it has to be, because it's the way the physical world works, and you just got to accept it. All right. Okay. Whereas accounting is doing what? It's taking these transactions that we've decided we want to enter into and record them. And so when you're trying to come up with something that's going to record what the world is doing, then you're going to have a system that's fairly easy to use to accomplish that goal, right? Okay, so it'll be an easy system, and it is a useful system, and it's really something that's going to be the main takeaway from this class, double entry, and they attribute it to this Luca Pacioli, whatever. Okay, now Martin Corporation, number 6, Martin Corporation purchased land in 2007 for $290,000. In 2013, they purchased a nearly identical parcel of land for $460,000. In the 2013 balance sheet, Martin valued these two lands at a combined value of $920,000. So what had happened? In 2007, they bought land and they reported it at $460,000. In 2013, they bought another piece of land and they recorded that. We'll call this first land. We'll call this the second land. They bought another piece of land, and this time they paid $920,000. I mean, excuse me. What was it? $460,000. Come on, John. The 2007 one, sorry guys, was $290,000. That's 2007 was $290,000. Okay, and then they bought another piece of land for $460,000 in 2013, and they compared the two and said, well, since they're identical, the correct amount to report this land in 2013 is $460,000. That's how they come up with the combined value of $920,000. Is that what they were supposed to do?
No.
No, they should have what? Left that second piece of land at $290,000. So what? $290,000 plus $460,000 is how much, guys?
$740.
The total should have been $740,000, you say?
Correct.
Okay, not $920,000. Okay, so what happens? They violated the historical cost principle, right? The historical cost principle says that you value fixed assets like property, plant, and equipment at historical cost, right? What you paid for it. Okay, good. The private sector organization involved in developing accounting standards, we saw that the SEC oversees what? The Financial Accounting Standards Board. They are a private sector, private not-for-profit organization that sets the accounting standards that the SEC has said, yeah, we recognize you, FASB, as the standard setter. And so corporations are required to follow the FASB standards. Question 8 was so great, I had to put it twice. Okay, so we already had this one. Okay, we already looked at A. That's just a typo on my part. Put the same question twice. Number 9, Andre Dickinson, owner of Andre's Fine Wine, also owns a personal residence that costs $475,000. The market value of his residence is $625. During preparation of the financial statements for Andre Fine Wine, the accounting concept most relevant to the presentation of his home is the economic entity assumption. Should he include his home on the financial statements of Andre's Fine Wines? Question?
No.
No,
No. Economic entity assumption says keep the assets of the owners separate from the financial information. I shouldn't just limit it to assets. The financial information of the owners separate from the financial information of the corporation. Good. Separate legal entities. The cost principle requires that when assets are acquired, they be recorded at cost. I mean, that one's almost, can you read? Cost principle. When you acquire an asset, you report it at its cost. Okay. The Deuce Company has 5 plants nationwide that cost $100 million. That cost a total of $100 million. The current value is $500 million. What should you report them at? Historical cost $100 million. The economic entity assumption requires that the activities of the entity be kept separate from the activities of the owner. I mean, that's almost right off of the slide, that question. A small neighborhood barbershop. Okay, small businesses tend to be sole proprietorship, guys. It doesn't have to be. I'm not sure that this is the greatest question in the world, but we do want to understand that what? We have sole proprietorship, we have partnership, we have corporation. Corporation is what? Is seen as a separate legal entity from the owners, and so there's limited liability. The owners are only limited to whatever their investment is in that corporation. Sole proprietorship, they can move against your own personal assets. Now, it's worth noting here, I think, as I hear myself give these explanations, that even though they can go against your personal assets for liabilities of the partnership, when you prepare your financial statements, you only include what? The financial information of that business. You don't bring in your personal information in there, even though your creditors and a sole proprietorship may move against your personal assets for liabilities that you as an individual have incurred in the operation of that business. Number 14, owner's equity. Now we know that assets equal liabilities plus, and we've been saying stockholders' equity, okay, but stockholders' equity is synonymous with the owner's equity here, okay? It means the same thing, okay? So is it true that if you were to take, right, assets of 100, right, I think we said our liability, our phone bill was 40, that means the stockholders' equity is 60, right? So is it true that if we were to take the assets of 100 and subtract the liabilities of 40, that we would be left with stockholders' equity of 60?
Yes.
That's all that's saying. Okay. Okay, good. Liabilities are what? Ooh, tough one. No answer shown here. Let's see if we can do this. Okay, I forgot to highlight this one. Liabilities are future economic benefit. Is a liability future economic benefit?
no,
No, that's an asset.
Number B,
Existing debts and obligations.
Yeah.
Okay, we have
Yeah.
a goal for that. Possess service potential. That's an
No.
asset. An asset possesses service potential. I have a delivery truck, I can use it to make deliveries. Are things of value used in the business? That's an asset. Okay, so these other three, the wrong choices, were descriptions of assets. Our bills, our liabilities, are existing debts and obligations. Okay, good. The accounting equation for this company, assets equal liabilities plus stockholders' equity. If Quattro purchases office equipment on account, okay, so we've seen what? We've seen liabilities now, guys, described as liabilities, pay bills. We've seen it described as getting something on credit, and now we're seeing it's being described that we acquired it on account. That means that what? It's going to be a liability. Think about it. When you go and you're, doing the thing at the, department store or something, they say, oh, would you like to open a Macy's account today? And we'll give you 25% off or whatever it is they say to entice you into that. That's opening a credit account for you, right? Okay, so account means credit in the accounting, world, right? And so you come over, and if that's the case, and I acquired equipment, are my assets going to go up?
Yes.
Okay, so I'm going to put that, what is it, 15,000? I'm going to put that 15,000 on the asset side. So that brings my assets now to what? 135,000. Okay. And notice, guys, when you're taking an exam, well, you'd only be able to get rid of A in that case, but at least A is not right. And then my liabilities are going to go up, aren't they?
Yes.
15,000. So I'm a little off here. I'm showing this, but that would bring my liabilities to what? 75,000. And nothing happened to stockholders' equity, so that stays the same.
Yes.
Okay. Okay, good. Balance sheet shows. Why do they call it a balance sheet?
Because it balances out.
Because it balances. Good. What balances? What balances?
Assets, and then the liabilities and stockholders' equity, which is common stock and retained earnings.
Wow. Somebody ate their Wheaties this morning. Okay. Really? Ugh, my pen's gonna stop working. So annoying. Just a second, guys. Okay, go back down. Give you a little speed reading exercise here. Okay, where were we? Right here. Okay, so we call it the balance sheet because assets equal liabilities plus stockholders' equity. Put it back in slideshow mode. Don't use bad language, John. Don't say bad words, John. Okay. I can't explain to you why my pen decided to stop working. So, because I need my pen, not necessarily for this question, but for some others, and we're getting a little bit towards the end of class anyway, I'm going to stop there because I probably have to reboot to get the pen working again. I have no idea why it's like, you know, the mystery of the universe. Okay, there's, you know, how did we all get here? And then there's the question of why does my pen decide to stop working sometimes so that I have to reboot? Okay, so we're gonna go ahead and we're gonna stop there. And we'll pick up with these last couple of questions here, just so you kind of see how we would have contemplated those. And then we will jump in with both feet into chapter 2 next time. Okay. Any questions, guys?
When will the recordings for the past class be available?
I would think in the next couple of days or so, I should be able to get those up.
All right, thank you.
Okay. Okay, guys. Anything else? All right, we will see you next week. Good work today. I'm proud of you. Okay, keep up the good work, and we'll talk soon. Okay.
Thank you, Professor.
Thank you,
Thanks.
Professor.
Bye.
Bye.
Thank you.
Bye bye.
Thank you. Bye.
Day.
Professor, I just have a quick question.